Sure.
It's going to be to the right, and I'll put it up.
Good morning, everybody. I think, Arif, Steve, Nico, those are just, the fact that they're able to come here and share their insights with you is incredibly valuable. I'm an accountant. Probably less so, right? I'll try not to bore you and put you to sleep. My firm is Early Growth Financial Services, and we are an outsourced financial services company. That means that we do basic accounting services for companies. Our clients are 95% venture-backed companies. We've got 400 clients. We help people with closing the books on a monthly basis, paying bills, dealing with payroll, dealing with taxes, 409A valuations, all the things that aren't operational or sales oriented, we'll probably be able to help you with. Our team is based with CFOs. We've got 25 on staff, and senior accountants who do the lower level. And there's tiered pricing for those different levels of services. So the kind of thing that I'm here to talk to you about is creating your 3-year financial plan, why that's important, how it has value to you as a business owner. And from our firm's perspective, we would have a CFO who would come in and help you with that. There are certain levels that you can get to on your own. If you've got an MBA, you've probably built your own financial plan. It's probably not a mystery to you how it works. Someone at our level can come in and help round it out so we can make it look like something that a VC would expect to see, as well as flush it out, because there's going to be a lot of costs and expenses and unplanned items that you want to be able to anticipate. But you could probably get about 80% of the way there even without that kind of knowledge. And that's what our presentation today is going to kind of touch on. What are those high-level things that you got to have, and why are they important? So you can see some of our clients here on the side. As I said, 95% of our clients are venture-backed. One of the reasons why we focus on the venture-backed space is that when venture capitalists who run a serious business entrust money to you, they have investors that they have a fiduciary responsibility to. So they expect that you're going to keep them informed on how your business is doing. They need regular updates on your expectations for your business, as well as a look on the historical performance of your business. So that's why a firm like us might be brought in, because we can provide those kind of services at a fraction of the cost of a full-time employee. So what's the whole point of putting a financial plan together? I think it's obviously a planning tool. It's a financial plan. But more than that, it's a communication tool. It's a communication tool both internally and externally. We got a quote here from Guy Kawasaki in terms of how he would look at a financial plan. It's basically putting the words to your business so that the financial expectations mirror what you're telling people the opportunity is within your business. But even more so than that, it's a way for you to communicate with your internal stakeholders, people on the technology side, on the marketing side, on the administrative side. What are your priorities as a business? What are you really focused on? What do you want to invest your money in now so that you can achieve the results that's going to take your business to the next level? And ultimately, that's what the financial plan is all about, is communicating how you're going to get to that next level. Because whether they're employees or whether they're investors, the reason they're on board with your company is because they expect you to take them to the next level. People are looking for success. That's why they're joining. They want to know how you're going to get there. So just as an overview about what we're going to get to, this is going to be about a half-hour presentation. It can be, question and answer. If you see something that's of particular interest to you, feel free to raise your hand. We'll take your question as it comes up. I'm going to try to keep the nomenclature and the terminology down a bit. So for those of you who are experienced entrepreneurs, you know what TAM, CAC, click-through, all those kind of buzzwords are. I'm going to try and just take it down a level so that I'm not throwing vernacular at you. We're going to talk about what your investors are going to be looking for in your financials. What is a financial model? What does it look like? What are the components of it? Setting financial goals and objectives. What does it mean to have a financial goal and objective? The concept of milestone. We're going to talk a bit about milestones. I think that's something where there's some nomenclature that hopefully this means something to you, but we're talking about how do you measure success. Milestones are very generic because they're going to be unique to each business owner. Every business has its own measure for success, and that's what a milestone is. We're going to talk about some boring accounting type stuff, what bottom-up financials are, financial projections. We're going to talk about what does it mean to allocate resources or define a spend by category. We're going to talk about budgeting and the whole process about budgeting. Top-down projections, which are different than bottom-up. We're going to talk about the concept of cost assumptions. What goes into making your cost assumptions? What kind of things do you look at? Where are you going to reach out to get information because you might not know what these things are? You're making some educated guesses. And then the whole concept of reforecasting, which is very important. So we're a big believer in just trying to keep things simple. You want to communicate the essential elements of your business and your financial plan, but you don't want to get bogged down in the details. We think a 3-year time frame is what we've seen venture folks are most interested in. You go much past 3 years and it's really a guessing game. You're most likely going to pivot away from whatever your current thoughts are about where you're going to go with your business. That might happen in 10 months. So most people realize that 5 years is way too far out in terms of where you're going to go. 3 years is a realistic time frame. Things might change, as I said, over 10-month time frame, so you may have a different look a year from now than you do currently, but it gives somebody who's an unbiased observer who's looking in from the outside and doesn't know the potential for your business, it gives them a numbers view about where you think things are going to go. It gives them an idea about the challenges that you might face. So if I'm looking at your financials and I don't know anything about you and I see that you have a certain expectation for revenue growth, I'm going to start asking some very pointed questions about how can you be so sure that that's where you're going to go? Or if you've got some idea about how you're going to scale your business up in terms of hiring technology professionals. What's your experience in terms of hiring technology professionals before? Have you done this before? Do you know what you're in for when it comes to trying to hire a very scarce resource? So it helps you understand what your cash burn is going to be. Everybody here is probably at different stages within their business. I mean, how many folks are actually part of a founding team? That's a pretty high percentage, right? So as a part of a founding team, you're either going to be at the bootstrap stage. How many folks are bootstrapped and haven't raised outside institutional capital yet? Okay, great. How many folks have actually been through a seed round? Congratulations. Congratulations. Anybody here who's passed a round? All right. Maybe you guys should be up here giving this talk. So anyways, the typical strategy, if you're going from, if you're bootstrapped, you've got some milestones you've got to achieve before you show that business traction that every business has to have and you can attract institutional investors. You might be able to get some angel folks to come on board before you've got that major traction. And that angel round might be anywhere from $200,000 to $500,000. When you're going to raise seed money, that might be $750,000 to $2 million. I've seen a seed done for $8 million with a team that exited Apple. So I'm going to speak in broad generalities here. Obviously there are exceptions to everything I'm going to say. But you got to start somewhere. So if you're in that seed round and you're going $750,000 to $2 million, people are typically thinking, okay, 12 months of operating, and then I need 3 to 6 months to raise my next round. So I'm thinking this cash is going to last me somewhere between 14 and 18 months. That's the general thinking. And as I said, there are exceptions. So what are you going to do in that 12 to 14 months? That's where this financial plan really has some real value, right? So it helps you understand your cash burn. It forces you to evaluate key performance drivers. Okay, so if I'm going to raise this much money and I expect it to last 14 to 18 months, where are the things that I'm going to be focusing on in terms of using my money? What are those important things that I'm thinking in my mind, I've got to get there so that my business has more value? This sort of also helps you to validate your assumptions. So if you were to build a plan today and you were to say, let's say, spend money on pay-per-click. So we're going to go out to do Google AdWords, and we think we're going to put out a budget of $20,000 our first month. What's going to be the results of that spend? Do you have any expectations? After you go through a couple of months of that, you're going to then come back and say, oh, we were way under in terms of our estimate of how much we're going to have to spend. Or, hey, yeah, we're right on target. This looks good. It also challenges perspective. When you make certain assumptions, one of the things that Steve mentioned is that there's real value in an experienced team. One of those real values is that you've done this before, so that there's some validity to your assumptions. Here, you're going to be challenging in your perspective. The next thing is an iterative process. It's an obvious, I would think, right? You learn from experience. Everybody who's in this room has had some success in life. You've learned from your failures. And hopefully you've prospered from a few successes. So along the way, you're going to learn, and you're going to want to apply that learning in the next iterative model that you're going to put out there. Insight into your business model. Clearly, you're going to be seeing, okay, what did we not anticipate? What do we need to factor in that we didn't factor in already? Clarifies decision-making process. What are our priorities? Priorities match dollars typically, right? You spend the most money on the things that have the most impact on your business. And it gives you leverage on accurate baseline valuation. So valuation is something that if you haven't raised money before, we're not going to spend a lot of time talking about pre-money valuation. It's something that's really a negotiation point. But when you've got some financials that you have some credibility with and some believability behind them, then you can have a more meaningful discussion about how you compare to another company that might have just raised money in a similar space and what their valuation might have been. I'm going to skip past this one and come back to that in a second. So first of all, I don't want to assume everybody here is going to be a venture-backed company. Probably 90% of you will want to be, but there are plenty of successful business models out there where people aren't going out there and asking for venture capital. So you got to decide what side of this diagram are you on. Are you going to be going after venture funding? If so, venture capitalists don't really care about when you're going to get to break even. Part of my role as chief strategy officer is I network within the venture capital community. So I run 2 business practice areas, but I also spend a lot of time talking to people like Steve and Nico, trying to understand how they look at investment opportunities. And I'll often come across founders who want to tell me, we're going to get to break even in year 2. People don't care. Venture capital don't really care about when you're going to get to break even, unless there's no more funding opportunities out there. But generally, they want to see the growth of your business. How fast are you going to grow your audience or your customer base? Because they want to put more money to work. They don't want to make their first round last. They want that first round to prove out the assumptions so that you can raise more money at a higher valuation in the next round. So because of that, you're going to be looking at a negative burn scenario. And you're going to want to know, what do I want to accomplish in this phase before I run out of capital so that the next round that I raise is going to be a positive up round. If you're not going to be going after venture capital funding, then you really do care about when you're going to get to break even, don't you? And a business plan has that much more value to you because it's going to give you an idea about how long is it going to be before I get to that break even level. When are the profits going to come in? Because I'm only going to be able to grow my business as the profits come back. Okay. I'm going to spend a little time talking about this slide in terms of what goes into a financial model and what is the process in terms of putting that financial model together. So first of all, everybody here, I think, probably intuitively understands that when you go out to raise money, one round has a certain pre-money valuation. The next round should have a higher pre-money valuation. I'm not sure if any of the venture capitalists are going to talk about how they look at that financial model in terms of how it grows. But, as a rough rule of thumb, if you're going into a seed round, people want to look at the math behind how that pre-money valuation works. If you're going out to raise $2 million and your pre-money valuation is $5 to $6 million, okay, that means post-money it's $8 million. That means you're giving up 25% of your company for that $2 million. Well, okay, that's great. Well, the next time around, you probably want to also only give up about 25% of your company. So if you do the math, you're thinking, okay, we want to raise $5 to $6 million in this next round. Let's say it's $5 million, and that means our pre-money valuation needs to be $15 million because post-money it's going to be $20 million, and I've now given up 25% of my company for that $5 million. So you can kind of see I'm going from a $6 million pre-money valuation to a $15 million pre-money valuation. How do I justify that? What are the things I'm pointing to that show that my company is worth this much more? So when you go from that seed stage, where people might invest on you because they really know the space and they're excited by it, you've got some early information that shows that you guys are incredibly exciting. Wow. Or your team is just a group of rock stars, and you guys are worth investing in, just because of the concept. You might be able to get that at the seed stage. It depends on where you're at. Enterprise companies are probably easier to fund at the seed stage because people realize the traction needed to prove out your business model takes a little bit longer when you're enterprise model. You might need to just have a beta out there when you're enterprise. If you're a marketplace, or if you're consumer, there's going to be a higher expectation about the kind of traction that you're going to have before you're going to attract that venture capital money. But in any event, you're going to have some traction. And when you go from that seed stage to the A stage, there's going to be a higher bar in terms of, okay, what's your customer acquisition cost? What's your churn? How much do people really love what you're selling, and do they want to spend time in it? That's the kind of information, and competitive landscape. What are the competitors out there doing as well? That's the kind of information that's going to help you increase that pre-money valuation from the seed round to the A round. And that's where you need to be thinking in terms of what your major objectives are. So right now, if you're at the bootstrap stage or the seed stage, you may just be thinking about, I just got to build something. I just got to get my beta out there. I've got a product and I've got to get it in customers' hands. I've got a marketplace and I just have to build the technology infrastructure first before I can get either side of the marketplace to be interested. I've talked to that enterprise and they say they're really interested if I can make this happen. So, it's pretty clear that early on, your challenges and where you're trying to get to are different than as you grow. But you want to have a good sense of what those objectives are at each stage of your business growth, and that's where the milestones come in. So, as you think about what's going to prove my business model to that outside investor or to that enterprise customer so that they're willing to take a bet on me and either sign up with me as a customer or invest money as an investor, as you're trying to define those stages of the growth of your business, those equate to milestones, right? The ones that you have to get to first before you can get to the next one are the earliest stage milestones. The earliest stage milestones are the ones that you're going to focus on as you're allocating capital and resources. Typically, people are going to allocate resources to technology. And we'll talk more about how you might make decisions about priorities of funding in a bit. So anyways, I hope that makes some sense about the milestones and what I mean by milestones and what our firm does. When we build a financial plan, and we'll talk about how we go about doing that with our clients, that's the kind of thing that we'll be talking to the founding group about. So key assumptions. Right? You got to make some assumptions. It's tough. We know that, but you got to start somewhere. How many technology people is it going to take? So in your financial, in your founding team, you might be the business guy. You might be the technology guy. You might be the marketing person, right? Wherever your hat is, you probably have one of those hats that you're wearing well. There may be a gap in your team in terms of who really knows how you're going to go to those next stages. That's where the real challenges come in when you're making assumptions. How much money do we need to allocate to marketing to grow our audience or our customer base? If you've got somebody who's an experienced enterprise sales guy, you're going to know more about that than if nobody on your founding team has that experience. So getting those key assumptions at least identified is going to be really important for you to have that dialogue with that venture capital investor. They're going to want to see that you've thought through carefully what it's going to take to achieve success. You may not know exactly what the answer is, but you know what the question is. And if you go out and talk to people who are in your space, your colleagues, people that you know, people you can get networked to, maybe not direct competition, but people who are kind of in this general space, you're going to get better information. For instance, how long is it going to hire me or take me to build out an internal 5-person IT team? And what are those roles going to be? If you don't have somebody who has managed an IT team in the past, do they know what it takes? Can they define the job descriptions for who's going to be on your team? So you can't just assume that those are going to be easy things to do. You need to start going through this process so that you get a sense as a founding member of your team, how well do we know what these assumptions are? Trending analysis is not so important at the bootstrap stage because trending analysis assumes I've got some historical experience, What happened in the past? Based on what I know from the past, what do I think is going to happen in the future? That's where trending analysis comes in. That's the value of building your plan at the earliest stage, because you identify the knowns and the unknowns, and you get a better sense of what the unknowns are to turn them into knowns. Key variables, that's along with the key assumptions. What are the things that are going to have the biggest impact on your burn rate? So usually it's headcount, right? It may be legal fees. It may be marketing costs. You need to have a sense, and that needs to be reflected in your model. So when you put a pitch deck or an executive summary together, you're not going to have the details of your financial plan there. It's going to be when you have that meeting with the VC. It's not going to be in the first meeting, might not even be in the second meeting, but at some point in time, you guys are going to dig in with the VC into your financial model. They're going to want to see what those key variables are. Customer acquisition cost is always a critical one. Timeline. Timeline is the big unknown, right? When you put your plan together and you make assumptions about how long it's going to take you to hire those 5 programmers, those 5 engineers, what happens if you don't get it done in the first 2 months? What happens if it takes 6 months? What's that do to your milestones? What's your timeline look like? And as you can see, this is a circle. So this is an iterative process, and we're going to talk about that in a little bit. Okay, now we're going to get into the nitty-gritty about just how do you pull this whole thing off. You're going to put your financial model together. You guys all realize now the value of having a plan. How do I make this plan happen? Well, you're going to go to people internally. You're going to go to people that know maybe more than you on your team about what do we need to do to get to this next stage. Here are the milestones. What kind of resources do I need? And it's going to be a back and forth collaborative process. So you're going to talk to people who head up each of the different groups. You're going to break down your company into different divisions. So you're going to have engineering, you're going to have marketing, you're going to have sales, you're going to have general and admin, and you're going to start to put those things together by talking to the executive team about, okay, on the marketing side, what's exactly our plan? Okay, and the marketing is going to say, well, it depends on where the product's at. You're going to go to the product team and the engineering side and say, okay, this is where we need to get to. This is, for us to be relevant in this space, this is what we have to accomplish. What do you need so that we can get to that point? So as you go through this back and forth process, and that's what we say, what is needed from a programmatic perspective, that just means from a basic business model perspective, right? As you start to draw down resources in one area or one department, it's going to take support in other areas, and you want to make sure that that's kind of a cohesive process. You can't add a whole bunch of internal staff without thinking about the HR side. You need to make sure that all the aspects of the business are covered. So how are you going to deal with your financial reporting issues? How are you going to deal with your taxes? How are you going to deal with all the different areas within your business? And then as you pull this together, you're going to try to start allocating resources relative to the milestone. So if we think we need to raise $1.5 million to achieve this milestone, well, this is how we're getting there, right? Here's the milestone. This is what's going to get us, or maybe it's a series of milestones that's going to get us to our next pre-money valuation, where we think our company has now proven that it's worth much more money. Okay, how did we get there? What were the resources that we allocated to get to that point? Something that we've got here is dialogue about wants and trade-offs. You may have an experienced technology guy who is sitting there pounding the table saying, I need 10 people to get this done. And those 10 people are going to cost me $1.5 million. And you're sitting there going, I can only raise, $1.5 million. How's that going to happen? So you're going to have to think about how can you work around what they're saying you have to have. So can you outsource? Can you get external contractors? We think that that's a great approach. It's a cost-effective way to deal with things. You might not have as much control over what those people do, but you might be able to save on cost. So you're going to have that process where you kind of cut people back. Probably. If they don't have, I have actually had a client where I went through the process and they had somebody on one of the marketing sides that didn't have experience in growing a department. And this guy had actually a profitable business, and he said, I'm allocating $500,000 to your department. I want you to grow out and create this growth within our company. And the guy said, I don't know how to do it. I've never hired staff. I've never managed staff. That might be your reality, in which case you've got to reach outside your organization to figure out how you're going to bring this person up so that they can figure out how to get things done. And then this dialogue is going to help you create the bottom-up forecasting budget that we're going to talk about next. So, bottom-up financial projection. In Basic Accounting 101, they teach you how to do budgeting. And many of you may have been through that process. It may not make the most sense, but especially in today's e-commerce realities like Twitter, etc., I don't think they really started with revenue. But generally in classic budgeting, you start with how much revenue are you going to be achieving as an organization. Obviously, enterprise sales, it's really important to have an idea about what your revenue numbers are. Your business model may not be critically important for those first 2 years in terms of what your revenue is going to be. You might just be building your audience, building the technology, whatever it might be. But planning always starts with your revenue assumptions. Once you understand what your revenue assumptions are, that generally dictates other resources that you need to accomplish that goal. So, if it's pay-per-click, you're going to have a certain spend that you're going to be allocating to marketing dollars. It may be the headcount that gets built out next. Headcount is usually the biggest driver of cost for early stage startups. So you want to get a decent sense of what it's going to take for you to build your team when it comes to headcount. And that's kind of what we're talking about in number 2 and number 3. So we're going to kind of go through this whole process where we start with revenue. We go to each one of the different departments. We might start with the technology side if that's where your focus is on building your business. Figure out, okay, based on this milestone that we have to get to, based on this assumption for revenue, what do we need to do in terms of building out our technology team? What's our expectation for time for bringing these people on board? What's our expectation for cost? Are we going to use recruiters? Are we going to use Craigslist? Are we going to network? How are we going to add these people to our team? And then what are going to be the other ancillary costs that are going to flow from that? So we're going to have supporting staff that we have to add. We're going to have other kind of advertising and marketing dollars that we're going to have to add. That ends up flushing out a bottom up. So the concept in a bottom up is you start with some assumptions about revenue. Then you go to your major cost drivers like headcount. Then you go down the list in terms of the priority of expenses, and you build what would look like a basic financial statement for those of you who have looked at financials before. So you see revenue, you see operational costs, you see marketing and G&A costs, you see other G&A expenses, and you see a bottom line. In terms of the relevant operational costs, this is the kind of thing where a CFO from our team might be able to add some value because we have experience in having built out dozens of financial models. We've seen realistic numbers. We'll be able to look at your basic projections and kind of figure out what's missing, what's not flowing, give you an idea. The overhead burden for hiring staff. You might hire somebody for $150,000. Well, what's the fully burdened cost of that $150,000 employee? Concepts like that. Customer cost details, human resource costs. Consultant and professional services, don't assume that you have to hire full-time staff. Like a firm like ours, 12 years ago when I went through my first round of a startup, if you wanted to have internal accounting and H&R resources, you had to hire people full-time. You can hire a firm like ours for a fraction of the cost of what a full-time employee costs. Similarly, legal costs, make sure you're working with firm. You guys are all here with Org, so I guess you probably get that. But a legal firm that understands the needs of startups is going to price their model accordingly so you can conserve resources early on. Outside consultants. So, it'd probably be great to get a VC's perspective on this issue. You definitely want to have somebody on your team who's the technology head who is the go-to person for the technology questions within your organization, but that doesn't mean that your entire team needs to be internal. I've seen plenty of models out there with people who have external IT teams outside the U.S. They're a fraction of the cost of U.S. employees. It's a great way to start building your technology platform. Obviously, there are risks. You know, you're giving up some of your technology know-how to people who are not in your control, and you have to kind of manage those risks. But when the biggest, sure thing.
Good for interesting. I'm wondering what the difference is between customer costs and sales and marketing costs.
Customer acquisition costs. So CAC. So what does it cost for you to get a customer? So a VC, a critical issue for a VC when you've got a customer-driven model, whether it's enterprise or consumer, is how much does it cost for you to get that customer on board? Then, okay.
How is that different than these other costs?
Well, the others are,
That doesn't fit into any of those categories.
so pay-per-click. If I'm going to do Google AdWords to get people to come to my website as part of my customer acquisition cost.
Marketing expense?
No, I would say marketing is more soft costs, like in individuals.
Sales and marketing.
Now, you're not going to take your VP of marketing and amortize them over your customer base to determine your customer acquisition cost, right? You're going to look at direct costs that it takes you to get that customer. You may look at specific salespeople, if you're in enterprise sales, to determine what your customer acquisition cost is. But that's going to be a very critical. You're not going to get to a Series A if you're an enterprise or consumer model without knowing real good information about your customer acquisition cost. Yeah.
So would TV go under customer cost or under
Sales and marketing. Yeah. T&E is supporting your sales. Just think customer cost details as direct costs of getting a customer on board. And you know, like anything else I've been talking about here, there are generalities. You can always modify a model to make anything work. Sure.
So before you ship that data, you're looking at the product that you have in shipment. At that point, is it reasonable for the
No. So you don't know. Right? I mean, you don't have customers. How could you know? Now, you can have assumptions along those lines, you know, right? And that's where the value of an experienced team comes into place, right? If I've done something similar to this somewhere else, I kind of have an idea about what those costs are going to be. If I'm building something from scratch or going into a new market that doesn't exist currently, I don't know. Right? And that's one of the reasons why somebody isn't going to, you're not going to get an A round at $5 million with a pre-money of $15 million when you don't know a critical issue like that. Because it's not just the acquisition of the customer, it's how much value does that customer have for you. So, that and value is determined in different ways. And what's the churn? How long does a customer stay with you before they drop off? All those things are critical. Yep.
What about growth tasks? Like if I have somebody that's doing we're not necessarily paying for it, but you got to download in our app, probably right on the app.
Right.
Do they count it as marketing?
I think that this is something you'd probably sit down and work through and think about. I don't know that there's a clear answer on that. I mean, if there are no other direct costs for acquiring customers, then maybe that is something that you look at in terms of cost of acquiring an audience, maybe not even customers. And these kinds of areas are the things that you just need to be thinking about if you're building your plan yourself, so that you don't have any gaping holes in your plan. Yep, go ahead.
I just want to add, to your question on what's the difference between sales marketing and customer marketing. I think the first one probably relates to the direct cost above the line, whereas sales and marketing is more on the operation cost.
Yeah. You must be an accountant. And then down below, I don't know if anybody in the room here has capital spending as part of their plan. Anybody who's going to need to buy equipment? There you go. Okay. You don't see it a lot these days because that adds a huge variability to a business model. One is how much are you going to need to spend on a capital basis before you get to your milestone that says we don't need to spend more, or we know exactly how much we need to spend more. And second is timing. How long is that investment going to take? So the fact that Steve was here, Steve's a hardware kind of expert. The VCs that I network with, it's a very small percentage will invest in hardware these days. But in terms of your budget, we'll talk about the difference between GAAP accounting and cash accounting, but that's a big issue that you have to kind of think through a little bit, which is, when you're spending dollars, make sure you identify the capital budget as well. So budgeting. This is going to be a little bit of an accountant geek in me coming out. There's a difference between budgeting and projections, and I think it's important for people here to understand the distinction and the value of each. When I'm building a budget, I'm creating a snapshot today of what my estimate is for 12 months from now. Generally, a budget for a startup isn't going to go beyond 12 months. It could go longer, but generally it won't. And the reason why that's important is you want to have a set point where you say, these are my current expectations. A projection is one that's an iterative process. It's always changing. You're saying, hey, 2 months ago we thought it was going to be 5 people on board. Right now, we've only been able to get 2 on board. I'm going to change my projections and what things look like for my current expectations in the business. So on one hand, it's good to have that budget, which is a set point, so that everybody kind of knows this is what we thought our business was going to do. If you get somebody to invest in you at a certain point in time, they're going to have expectations in their mind based on the financial model that you showed them when they invested. And it's important to manage expectations. That's one of the huge benefits of a financial plan, is that you're going to manage the expectations of your investors and your internal employees, your internal stakeholders, through the use of this financial model. And when things change, if I go into a month, let's say I'm now going into my February thoughts, and I look at my December results and I say, we thought we were going to burn $100,000 and we burned $150,000. Now I got to be thinking more about January, February. What's this do for my time frame for when I need to go out and raise capital? What's this going to do for my relationship with my venture capital investor? Do I clearly understand why I spent $150,000 and not the $100,000 that I thought? Right? That's the value of going through that iterative process and looking at projections going forward. So they both have value. In this presentation, we kind of bounce back and forth between budgeting and projecting, but I think you'll see that when we talk about iterative, when we talk about changing things, that's the forecasting or the projection process, not the budget. But in any event, you're going to look at budgets on an accrual basis because that's how the venture capitalists look at the world. Their reporting flows up on an accrual basis. For their entire portfolio, they bring all their investment portfolios together in one report that values all of the financial results for all their businesses, and that's done on an accrual basis. The big difference between accrual and cash, if you're not making capital investments, the big difference is revenues are recognized when earned and expenses are recognized when incurred. If you're a SaaS-based business, the biggest impact to you is that if you're selling a subscription model where I collect $10,000 for a 12-month service, you don't recognize revenue when that $10,000 is received. It's cash. Love to get it, want to get it up front, not at the end, but it's not recognized as revenue until that subscription period is amortized ratably over those 12 months. So you only recognize whatever that is, $800 a month, $825 a month, as opposed to the full $10,000 up front. Report budget by department and major cost drivers. We've kind of talked about that a little bit. Plan actions, okay? This is why you're putting this financial plan together, because it gives you actionable items. What do I need to do? What steps am I going to take? That's where costs are delivered, right? I take an action, I pay money. I close business, I receive money. Identifying key variables, that's what the budget is all about, right? It's, okay, if I see that I'm spending $100,000 a month, I look at this, I can see, just by looking there, what the biggest numbers are, right? I can see what my most important assumptions are and what my key variables are. The key revenue assumptions, clearly at the earliest stage from Bootstrap, you're trying to figure all that out. You may not know. It may depend on where you're going with your beta. It may depend on customer feedback. It may depend on how well you build out your sales professional team. They might be able to help you with pricing. But in any event, it helps you identify what those key revenue assumptions are. Number of customers that you're going to acquire, the price per customer you're going to charge. Maybe it's just an audience and how fast that audience is going to grow. those different things. And then it makes sense to run different scenarios. It makes sense to do a kind of what if scenario. So if I end up spending more than I think, if I can't hire the staff that I think, what's my best worst case scenario look like? It's usually pretty easy to do when you've got things built in Excel. We're going to kind of reiterate some of the things I've already alluded to earlier in the discussion. From a milestone perspective, that's where you're adding value to your business, right? So milestones are key. If the company's been around for a while, you look at your historical costs. Okay, what do we know based on what we've accomplished so far? And what do we need to accomplish before we run out of money, or before I need to start talking to investors about my next round? Okay, ask budget owners what they need to accomplish their goals. So hold people accountable within your organization. It's not going to just be you at the founding team. It's going to be other people that are part of your key membership organization, your key stakeholder organization. Make sure they understand what's expected of them. Hold them accountable for what they need to deliver. As you're going through this, you're going to have trade-offs. You're going to say, hey, this is the most important area right now. Engineering is where we need to focus on our dollars right now. I'm sorry, we thought we were going to go out and do some customer acquisition costs, build our audience, but we really need to focus on dollars. You may have to switch in midstream so that you hit that number one milestone. Trending analysis. Trending analysis means I'm going to look at the months over time. So I'm going to look at January, February, March. How do things look? Some things are going to be up and down, up and down. Some things are going to be pretty steady, and some things are going to ramp up or decrease over time. That gives you an idea about what the future might look like, right? Because that's what you're trying to do, is anticipate the future. And then trending initiatives. Trending initiatives is just a way of using trending analysis to make decisions about the future. Top down, we're going to talk real quickly here. TAM, total addressable market. VCs want to invest in things that are going to be big. Right? They want to get a 10x on their fund. They want to know, how big is this market that you're going after? Is it worth my time as a venture investor? They want to start to understand how well you know the market, right? How well have you looked at it? Once you understand what the total addressable market is, you narrow it down and you say, this is the market size that we're going after right now. This is our particular segment. And then you extrapolate to calculate the total potential revenue. So you might have a certain market that you're going after today with your current model, and as you grow and as you raise more money, that may expand. Very often they're looking for the BHAG, right? What could this be in terms of huge from your idea? Because we want to see huge. But now we understand, you guys are early. You can't get huge tomorrow, so you're going to have to get there in stages. Can you go after an intermediary market or an interim stage that can establish viability for your business and create more value for your business so that you can raise more money and go after that bigger idea? Reforecasting. Don't do a 5-year plan. We talked about that. You want to have this be an iterative process. We've talked about that. This is where the concept of a projection comes in. You don't want to keep static. If you've learned new information, apply it to your model. That's where our CFOs typically add value with our clients, is we look at last month's results, we compare it to the projections that we had in place, and we talk to the management team about, hey, we might want to change some of these assumptions going forward because it now looks like we're going to be here in 6 months. Well, you could be in a very different cash position once you reforecast based on those assumptions. And that's the most important thing from a financial perspective, is keeping your finger on the pulse of the cash burn and what your cash out date's going to be. So that kind of concludes the presentation. Does anybody have any questions that we haven't touched on, or perk any areas that folks would like to explore further? That's like me asking you. It really so much depends. You could go to a textbook and get something, early, but it would almost be worthless to give you a template, because you really have to kind of ask the basic questions about where you're at. It have to be at least a half-hour consultation to give you something that's worthwhile.
Yeah, for seed stage, what sort of projections or benefits and tax on top of those papers?
It all depends on what the current rules are, but I'd say 14% in California. Because you got the employer portion. That's all over the board. It depends on the age group and who you go after with benefits. Zenefits is a good model out there. If you go to TriNet, which has a lot of value, you're probably going to pay more on the benefit side. So it all depends on how you approach the answer. That's kind of where our CFOs step in and give you some experience. It depends on what your choices are. I'd sit down and talk to you and say, this is the lowest cost, this is the highest cost. Yeah, I mean, and it depends on the age of your employees, right? So if you got a bunch of 25-year-old single guys, they're a heck of a lot easier to insure than people my age. Yeah. Oh yeah, I think Lauren can probably. Are we providing slides to folks afterwards? Sure. And you got my contact info here. If you have any questions and want to follow up, let me know. Yeah.
Contractors or
You have to deal with the harsh realities of the world, right? So if you can hire somebody, it depends on how critical it is. For me, if I was in your shoes, I'd be most worried about, can they take what they've developed and use it outside of my business? How am I precluding them from, I'm giving them direction. I'm adding a lot of, value to what they're working on. Can I segment it out so that they can't take what I'm doing with them and run with it and take it to a competitor or knock me off in a foreign country or something like that? That would be my greatest worry. Internally, your VC investors, my experience is going to be, and you're going to have Nico up here so you can ask him, but my experience is going to be they want to know that number one guy is the CTO. Right, that guy is internal, that you haven't outsourced that to somebody who is a contract employee that you don't have any control over, because they're going to be making key decisions. And ultimately, when you sell your company, if that's your strategy as part of an M&A transaction, the acquirer is going to be acquiring not just your technology but your team. And so that's a key element to consider when you're thinking about your exit is, I got a core team here that's going to develop something internally with a bigger company. But if that technology guy isn't internal, I've lost a negotiation point. Yeah.
Let's say that I want to hire end of year 10 employees. And I budget for those 10 employees, but hiring them will take time. Some of them might not find the right time. 6 months. So how do I financially model that? I know how to calculate employees a lot,
Right.
but I don't know exactly where they're going to come from.
Sure. So what you do is you build a little spreadsheet that says, here are the roles, the titles, the salaries, the benefits. This is what I expect their start date to be, and this is what their end date is going to be never, right? So here I've got a model, and I'm going to guess when their start date's going to be, right? And then your Excel spreadsheet grabs those placeholders and puts them in the budget. So 1 month in, you're going to have a better understanding of how long it's going to take to hire those people. You change it, right? Next month in, 2 months in, you're going to have a better idea about where you're going to be. You change it. 3 months in, right? I mean, this is why it's an iterative process. You got to start somewhere, and you got to have a guesstimate.
And there is no standard guesstimate.
It depends on what you're trying to hire for. It depends on how available the workforce is, right?
So what are you doing with the actually starting with that this is what I need to accomplish what I want. This is how I then go down to this is how much I think I'm going to be bringing in actually.
No, sorry. The first step is, what do I want to build, right? So in today's world, technology world, it might be defined in terms of technology. It might be defined in terms of audience. This is where I'm trying to go with my business. Then it's, what do I need to do to get there, right? And you might be wrong about that, but you want to be clear that you're communicating, where do I want to go, right? Because that shouldn't change that much until you make a major pivot, right? Until you say, I see a better opportunity over here. Now I'm going to change where I want to go. And that's going to change my resource allocations. But if you start with saying the resource allocation, that's the hardest thing to measure. You can have a better idea about where you want to go. Any other questions? Go ahead. Sure. What you should have on your pitch deck, and we do demos or webinars on pitch decks, and we can follow up and give you some examples. High-level slides, 13 slides. Guys Kawasaki's The Art of the Start is a great place to go to see what your pitch deck looks like. One slide on, just this is what year one's going to look like, year two, year three in your pitch deck. This is a top-down model. This is a total addressable market. This is our market. This is what we think our total revenues are going to be. So maybe one slide for each in your pitch deck. But when you get into the diligence, okay, you're going to want to have quarterly financials for your first year, which are going to be built up from monthly, so they can get in and look at it on a monthly basis. Year two and year three, generally they'll just look at it on an annualized basis, on a summarized basis. But you'll probably have the detail to be able to show them monthly if they want. But 3 years only, quarterly on the first year, annually for year 2 and 3. Well, Nico's about to talk about that, but I would say my experience is they want to see a one-page executive summary, 1.5 maybe, because what happens is I'll send something that I think Nico might be interested in to him. He wants to be able to evaluate in 10 minutes to see whether he wants an introduction to the founder. So if it comes in a standard format that he's used to seeing, it makes it a lot easier for him to process that information. So I can give you examples of what a one-pager would look like, and then a pitch deck, 12 slides so they can see what the problem is, the market opportunity, your technology, what's exciting about your team, blah, blah, blah. There's about 12 slides. And yes, the format is usually specific, yeah. Oh no, we've got a whole marketing team that we can connect you to. They do this for a living. They'd be happy to give you this. Okay, thanks everybody.